Hi, this is Rakesh Kabra with a new accounting video, and in this video we will learn how to calculate a return on capital employed. So before we see the formula to be used to calculate return on capital employed, first we need to understand that what do we mean by return and what do we mean by capital employed. So capital employed means long-term funds invested in the business. Long-term funds invested in the business. Okay, and when I say long-term fund, it means capital which is usually invested by the owner and plus non-current liability such as bank loan, non-current liabilities. So total of capital plus non-current liability will be known as capital employed. Suppose to run a business we need $100, but I have only, let's say, $80. So that is not sufficient. So definitely I will take bank loan or long-term borrowing. So $20 I have taken as a bank loan. So $80 invested by the owner and 20 taken as a bank loan. So now we have total $100, and that $100 we employed in the business. So this is the meaning of capital employed. Now we will understand that what is return. We employed $100 in the business, and or we can say that business is using $100, and against that $100 what business is giving us. So that is known as return. So here return means net profit before interest on non-current liability, or you can say interest on bank loan also. Okay, so this is the meaning of a return. So I hope this is clear. Return means net profit before interest on bank loan, and capital employed means amount invested by the owner plus the non-current liability. So now let's solve the question. So first we will see the formula to be used to calculate return on capital employed. So the formula which we use is net profit, as I told you earlier, before interest. Multiply by 100 and divided by capital employed. So now we will use this formula and find out return on capital employed. So we will be using this data. Okay, so if we see this income statement, so we can see net profit, which is $15,000, and this $15,000 is actually after loan interest. So this interest I will add back to this 15,000 because we need to take net profit before interest. So net profit before interest is actually 15,000 plus $1,000. So it will come $16,000. 16,000 multiplied by 100. Now we will take capital employed. So for that I need capital plus non-current liability. So let's see the statement of financial position. So here we can see the capital is actually $123,000. This is capital, $123,000 plus non-current liability we have here, loan from AB Finance Limited, $20,000. Okay, so this is the non-current liability. So 16,000 multiplied by 100, 16,000 multiplied by 100 and divided by $143,000. Now let me calculate 16,000 multiplied by 100 divided by $143,000. So it will come 11 point, let me convert it into percentage, 11.19 percentage. So this is how we calculate return on capital employed. Now we have to see that what is the use of calculating this return on capital employed. Here we have calculated return on capital employed, that is 11.19 percentage. Now what is the use? Let's assume in my business, as I told you earlier, $100 we employed, right? If same $100 I put in the bank, and imagine bank is giving me 12% return, right? So I can easily analyze that there is no point of running the business. Business is giving me only 11.19 percentage after taking lots of risk. Whereas if same $100 I invest in the bank, so I can easily earn 12% return without any risk. So I can make out the conclusion that there is no point of running the business. What is the best solution now? Take out this $100 from the business and put in the bank, and easily we can earn without any risk 12%. So this type of decision we can easily take by calculating return on capital employed.